What is up, navigation traders? Hope everybody had a great weekend. It is Monday morning, just before the markets open. Now, I am not in my normal office here with my normal technology, so hopefully the audio and everything is coming through okay for you. So doing a little mobile live recording. So hope it's coming through okay. But this is Navigation Trading Live. We do this every Monday morning before the markets open. We stream live from our Facebook channel, which is facebook.com/navigationtrading, and simultaneously to our YouTube Live, which is at youtube.com/navigationtrading. Make sure you connect with us on social media. That's where we make a lot of big announcements of upcoming courses coming out, events that we've got going on. So to stay in touch with everything that we're doing, make sure you connect with us there. And then don't forget that this session is really all about you. So if you have any questions or comments or anything that you want us to cover on this live broadcast that we can go deeper into for you, shoot us an email, info@navigationtrading.com, or you can always leave comments here on Facebook or YouTube as you're watching this broadcast. So the markets are going to open in here just here in about a few minutes, but let's go to the platform. And before the market opens, I want to take just a couple minutes to give a little bit of an overview and kind of our thought process going forward. So obviously we had this huge run up in the market, just kind of a one-directional grind higher, and then boom, the shoe fell out from under us here. So when we were grinding higher, naturally a lot of our equity-based positions, and we're looking at the S&P 500 right now, but a lot of those equity positions through adjustments and rolls, we naturally gained more and more short delta, meaning we had a bias to the short side in the market. So when we had this huge sell-off, that actually benefited many of our positions and extremely benefited our portfolio overall. So now that this has happened, what that did is that actually ate up a lot of our short delta. We rolled and adjusted and booked profits in some of those short positions. And so now the question is, where do we go from here? And obviously the market can do anything. So we're not in the business of trying to predict market movement. We're trying to set ourselves up to be in the best position possible. So where we stand right now, and our pro members know this, but we have a little bit of a long tilt, a long bias in our portfolio, which, as volatile as things are right now, this thing could surely roll over and go even lower, or it could rip back higher, or it could just kind of grind and trade sideways. So the goal here is we want to really keep our balance, our portfolio balanced. If the market goes higher, then we're probably going to add on some short delta positions to to protect ourselves from any reversal and down movement. Right now, our like I said, our portfolio is a little bit biased to the long side, but we'll be adding positions to balance that out even more and get to a position of what we like to call delta neutral. Okay, so I think that's the best place to be right now with implied volatility as high as it is, just to continue to sell premium. We like to sell premium, iron condor, strangle, straddles, butterflies, when implied volatility, when the percentile and the IV rank that we use is above that 50 level. Well, we've got, levels up near 100 at this point in a lot of stocks and a lot of ETFs, especially equity-based ETFs. The one thing that you want to remember is you don't want to get too overweight in any one category. So you don't want to be centered around where price is right now. You don't want to be too overweighted in stocks. You don't want to be too overweighted at these prices in bonds or notes or gold or oil or anything else. You want to have a diversified portfolio, not only in the underlyings that you trade, but also the strategies and also the price points. Okay, and I think that's that price point diversification is one that is a little bit difficult for people to grasp when they first start trading, because they think, oh, implied volatility is high. Oh, it must be a good time. Let's load up. And you don't want to do that. You still want to spread your entries over time and spread your entries over different price movements, because a lot of stocks move in a very correlated fashion. In other words, they move together, and then same thing with the other categories, bonds, gold, oil. You don't want to load up all on the same day at a specific price point, because markets move. So you want to spread those out over time, so that over time you're setting up neutral trades here and here and here. That way, as the market moves around, you're going to be booking winners in some, adjusting others, and you're continually monitoring and managing that portfolio. Now, at Navigation Trading, we monitor and we manage and we adjust each position separately, but we look at all of our positions together in a portfolio, from a portfolio standpoint. Okay, so if that's confusing, you'll want to go through some of our courses to understand that, from a directional bias standpoint, we always look at our portfolio as a whole, but we manage our positions within that portfolio on an individual basis. So I hope that makes sense. So it looks like the market is open. So let's go through and take a quick scan. S&Ps are up about 25 points. You can see here, we've been looking at the S&P chart. We've got a little pop up to the upside there. Same in NASDAQ, up 65. All of them are up about 1%. The Russell is is lower than the rest. It's only up a fraction, less than 1/4%. But equity's up for the most part overall. Oil's up about 1.5%. Silver and gold are up a little bit. Notes and bonds, bonds are pretty flat to up, and notes are down a little bit. All the grains are up. Soybeans, wheat, corn up over 1%. The euro's flat to a little bit up. And then if we look at some of the corresponding ETFs, kind of the same story. The VIX is actually taking a breather today. It's down with the market up. Some of the volatility is coming out of the market. GLD, pretty flat to up a little bit. Gold, TLT, the bond ETF, up a little bit. Some of the emerging markets, EEM and EFA, up. EWZ, the Brazilian, up. Mexican ETF, EWW, up about 1%. XRT retail, slightly up. FXI, the Chinese large cap, up about 0.75%. And then some of these oil and energy related ETFs are up about 1.5% or so. XBI Biotech's up about 1%. XLU is the utilities. It's down slightly. And then if we look at some of the big stocks that we track, Apple, Adobe, Autodesk, all up over 1%. Amazon up almost over 1.5%. Baidu up almost 2.5%. Capital One up over 2%. Cisco up 3%. Just looking at some of these big movers here as I scan through. Momo up over 3%. McDonald's up almost 3%. You can see having a nice little pop off the bottoms in McDonald's there. A lot of the financials. Morgan Stanley up over 2%. Let's see some of these others here. NVIDIA. Snap had a big pop after earnings. It continues to stay bid up higher. And that's about it for the major stocks that we follow. So what I want to do here for our trade of the week is I want to look at adding a position in SPY. So SPY is one of the most liquid ETFs out there. We do not have a current position on it with our pro membership with our navigation alerts. So I want to go ahead and sell some premium while we've got high implied volatility in SPY. We've got positions on in some of the other stocks and indices that are very correlated, but with price movement, we look at this as a good time to center a new position around the current price, kind of like I talked about at the beginning. So if we go to SPY, go to the Trade tab, and take a look at about the 20 delta, which would be the 276 strike. And we do sell Iron Condor. I also want to point out what huge put skew we have going on here, and I'll get to that whenever we put the graph up. So go about 3 strikes wide here is what I like to do on SPY. And then on the put side, we're looking at the same delta, about the 20 delta, which would be the 248 on the put side. So jump down to 248, and then 3 lower than that would be the 245 is the one that we would buy. And so if we take this to the Analyze tab and take a look at the graph, what you'll see here is you can see that we've got a lot more room to the downside than we do to the upside, and that's what we call put skew. And basically what that means is, especially when things get volatile like they are now, you'll see the put skew get even bigger. And the reason is because puts are priced higher than calls when it comes to stocks and stock-related ETFs. And that's because we know, and we've seen it just recently, we know that the velocity of a down move is greater than that of an up move. And so that's why you'll see that big extra buffer to the downside as opposed to the upside. So I like to play that put skew, meaning I like to play it just as it comes out with the deltas that we've chosen, selling the short strikes at the 20 delta. And you know, some people like to center this a little bit more. So you could move your puts a little bit closer, or you can move your calls a little bit further out to get price really balanced right in the middle of your graph. But I like to take into the account that put skew. It gives us a little bit more short delta with the trade. So you can see we've got a negative 3.57 delta is where that is. So if you balanced it more, you could get that delta down to pretty neutral or 0. But I like having a little bit more room to the downside, especially where we're at with volatility and everything. So that's what we'll be looking at for our trade of the week. So I'm going to try to get filled on this trade. And if I do, I'm going to shoot this out to pro members. If you're not a pro member, you can go to NavigationTrading.com, click on Pro Trial, and we are still doing a 14-day trial for just 14 bucks if you're interested. Thanks, everybody. Have a great week of trading, and we'll talk to you next week.